You have a $30,000 roof, the insurer approved the claim, and the check was $9,000. You didn't get cheated exactly. You got depreciated. Here's how to get the rest. That gap between the approved damage and the money in your hand is the single most misunderstood number in home insurance, and almost nobody explains it before the check arrives. So here's the whole picture. The real difference between actual cash value and replacement cost. Why your roof's age quietly ate most of that check. The second check, recoverable depreciation, that some of you are owed but never claim. Why some policies never pay it back at all, and exactly what to do if the number still looks wrong. Let's put real numbers on this, because the terms alone don't land. Texas's own insurance department walks through a $10,000 roof with a $4,000 deductible. On a replacement cost policy, you get $6,000 no matter how old the roof is. On an actual cash value policy, that same claim pays $4,500 if the roof is 5 years old, $3,000 at 10 years, and at 20 years, the payout can hit zero because the insurer decided the roof had already used up its useful life. Same storm, same damage, same deductible. The only difference is which of these two words is sitting in your policy. So before you do anything else, go find your declarations pay and see which one you actually bought. Here's the part that actually explains that $9,000 check from the top of the video. The adjuster's estimate doesn't just say roof damage, $30,000. It runs a depreciation schedule against it, the same math you'd use on a car. Figure out the roof's expected lifespan, figure out how many years of that lifespan are already used up, and subtract that percentage off the top. A 15-year-old roof rated for a 25-year life has already burned through 60% of its value in the insurer's math. So 60% of that $30,000 estimate gets held back before you ever see a dime. That holdback isn't hidden. It's usually printed right on your estimate as a line item called depreciation, often split into recoverable and non-recoverable. That one word, recoverable, is the whole ball game. And it's exactly what the next few minutes are about. Study that bottom row for a second, because it's the row that surprises the most homeowners. Even if your policy's headline coverage says replacement cost on the declarations page, an endorsement buried in the fine print can quietly change loss settlement for the roof, specifically once it passes a certain age, commonly somewhere between 10 and 15 years, depending on the carrier and the material. So you can genuinely believe you have full replacement cost coverage on your house and still get an ACV settlement on the one part of it that just got destroyed. The other version of this is a roof payment schedule, a sliding table that doesn't wait for an age cutoff. It just pays a shrinking percentage every year. So an 18-year-old roof might recover a fraction of what a 5-year-old roof gets for identical damage. Neither of these is illegal. They're just easy to sign without noticing. This is the single most missed step in the entire claims process, and it's costing homeowners real money every year. If you have a replacement cost policy, that first check was never meant to be the whole story, it's advance funding. Once you actually pay a roofer and the work is done, you send the insurer a copy of the paid invoice, and they cut a second check for the depreciation they held back. The catch is that most policies put a clock on this, often somewhere between 180 days and 2 years, spelled out in your own policy. So if you pocket the first check and never finish the roof, or finish it and forget to ask, that money can simply expire unclaimed, sitting in the insurer's favor forever. Set a calendar reminder the day you get that first check, not the day the roofer finishes. So why would anyone end up on a policy like this? Mostly because it's cheaper, and because the insurance industry got burned. After the brutal hail seasons Texas and its neighbors went through in the years around 2017 to 2021, some roofing contractors were caught inflating estimates, or, in the worst cases, actually damaging roofs themselves to manufacture a claim, and insurers responded by pulling roof coverage back to ACV or a payment schedule across huge swaths of hail country, sometimes in exchange for a lower premium up front. If that's genuinely the policy you were sold and it was disclosed, there's no missing check to chase. The settlement you got is the full settlement, full stop. The mistake isn't having this policy. The mistake is not knowing you have it until the storm already hit. Walk this in order, because skipping step 1 is exactly how people end up disputing the wrong thing. Before you argue about a single dollar, go find out what you actually bought, pull the declarations page and any endorsement schedule, and confirm whether your roof specifically is RCV, ACV, or on a payment schedule, because that answer changes everything downstream. Step 2 is where you stop taking the adjuster's number at face value. Ask for the line-by-line depreciation breakdown, not just a total, because that's where missing code upgrade items and mispriced shingles hide. Steps 3 and 4 are the ones people skip out of exhaustion. You have to actually finish the roof and hand over the paid receipt, not just start the job, or that second check never triggers. Step 5 is the payoff for doing 3 and 4 right. And step 6 is your safety valve. If the number is still wrong after all that, you don't have to just accept it. There's a formal amount dispute process and a free regulator complaint, both coming up next. This is the tool sitting in most homeowners' policies that almost nobody uses until they're desperate, and it's built exactly for this fight. If the insurer agrees your roof is a covered loss, but you and their adjuster are $15,000 apart on what it costs to fix, either one of you can demand appraisal in writing. You hire your own appraiser, they hire theirs, and if those two can't agree on a number, they jointly pick a neutral umpire to break the tie. Whatever two of those three sign off on becomes the binding number, no lawsuit required. You do pay for your own appraiser and split the umpire's fee, so this makes the most sense when the gap in dollars is big enough to be worth it. And remember the ceiling on this tool from a few slides back. Appraisal can force a fair price, but it can't create a recoverable depreciation benefit that your policy never had in the first place. Here's a fight that shows up constantly on roof and siding claims, and most homeowners don't know it has a name. Say only the back slope of your roof got hit by hail, and the insurer wants to shingle just that one slope, except your shingle line was discontinued 3 years ago, so the patch will visibly not match the rest of the roof. A model regulation that many states have adopted in some form says an insurer generally has to make the repaired area reasonably uniform in appearance with the rest of the property, not leave you with a two-tone roof. Ohio and Kentucky, for example, have written versions of this directly into their own insurance regulations. But go in with your eyes open. Not every state has adopted this rule, and even where it exists, most states don't actually let you personally sue over it. It's a factor a regulator or a jury can weigh, not an automatic win. Check your own state before you lean on it too hard. Take this table back to that $30,000 roof and that $9,000 check from the very start of the video, because now you have enough information to sort your own claim into one of these two columns. If you've got an RCV policy and you finished the roof and turned in the receipt, and that second check never came, or the estimate has the wrong shingle grade or is missing code-required items, that's the left column that's worth pushing on, with appraisal or a complaint behind you. But if you genuinely have an ACV-only policy or a roof payment schedule endorsement you were shown and signed, and the estimate itself is accurate for a roof that age, the number that stung is still the correct number. It's just a hard number, not a wrong one. Knowing which column you're in before you start fighting saves you months of a battle you were never going to win. Most of the money left on the table here isn't lost to some insurer trick. It's lost to paperwork nobody warned people about. The most common one: homeowners cash the first check, patch the roof themselves, or just never get around to a full replacement, and the recoverable depreciation sits there unclaimed because the work that would unlock it never actually happened. The second is close behind: the roof gets replaced, but the receipt gets filed in a drawer instead of sent to the insurer before that 180-day to 2-year window closes, and the second check simply expires. And the third is quieter. People see one bottom-line number on the estimate and never ask for the breakdown behind it, so a mispriced shingle grade or a missing permit fee line just rides along unnoticed. Ask for the breakdown, finish the job, and mail the receipt in that order. There's a real point where this stops being a spreadsheet problem and needs another set of hands. Filing a complaint with your state's Department of Insurance costs nothing. In Texas, for example, the department contacts the company and requires a response within about 15 days, but know its limit going in. A regulator generally can't referee a pure factual disagreement, like whether damage was really hail versus normal wear. That's exactly when a public adjuster, who works for you and rescopes the damage professionally, or an attorney, earns their fee, especially if the dollar gap is large, if you suspect the depreciation math itself was rigged against your roof's real condition, or if a matching denial is costing you a full roof replacement instead of one slope. One consultation is a small price next to a 5-figure gap. So here's what to actually carry out of this video. First, get the vocabulary straight. ACV pays you the depreciated value and stops there. RCV pays the same amount up front but owes you the rest once you actually rebuild. Second, that second check isn't automatic. It needs a finished roof and a paid receipt in the insurer's hands before your policy's own clock runs out. Third, go check your own declarations page and endorsements today, not after the next storm, because a roof age schedule or an ACV-roof endorsement can be sitting quietly in a policy you thought was full replacement cost. And last, if the number still looks wrong after all that, you have real tools: an itemized breakdown, the appraisal clause, and a free state complaint before you ever need a lawyer. That $9,000 check from the start of this video might genuinely be the whole story, or it might be a first check waiting on you to finish the job. This video is general education, not legal, financial, or insurance advice, and the rules covered here: depreciation calculations, recoverable depreciation deadlines, roof age endorsements, matching rights, and appraisal and complaint processes vary by your state and by the specific terms of your own policy. It was researched and produced with AI assistance, including script research, voice, and on-screen graphics, and reviewed by a human against the cited sources before publishing. Before you act, read your policy and any roof endorsement in full. Check your state's insurance code and your state Department of Insurance's process. And if a large gap, a denied claim, or a lien is on the table, talk to a licensed attorney or insurance professional in your state. Subscribe. Homeowner Rights Explained breaks down one homeowner right every video.